prime source of independence. I can say what I think. After declining sharply for a year, economic growth stabilized in the middle of last year and then turns positive, growing at an annual rate of nearly 4% since the second half of 2009. The data released last Friday estimate that growth expanded at a respectable 3.2% annual rate in the first quarter of this year. I expect GDP growth for the fourth quarter to fourth quarter of this year to be around 3.5%, and the same for 2011. That's somewhat stronger than what I think the underlying trend is going to be, which is probably the underlying trend of economic growth in this country is probably more like 2.5% to 3%. So we're moving along at a clip a little faster than our underlying trend. Of course, no recovery is entirely smooth. There will be ups and downs along the way. In the housing sector, we are certainly seeing a mix of both good news and bad news. Many housing indicators appear to have stabilized, but at very depressed levels. Even with the support of low interest rates, federal stimulus programs, and lower housing prices. New and existing home sales have been bolstered recently by homebuyer tax credits introduced last year. However, even with this program, we have yet to see a sustained upward trend in sales. Going forward, a large inventory of homes will likely limit the growth of housing starts and permits for a time yet to come. However, I am encouraged that some regional business contacts in home building continue to report to me considerably stronger sales this year compared to last year, even among buyers who are not eligible for the tax credit. During the recession, uncertainty about the depth and length of the downturn, very weak demand, and difficulties in getting credit caused businesses to hunker down, cut costs, and refrain from spending. Yet as firms have gradually become more convinced that a sustainable recovery is in fact underway, and as financial conditions have strengthened, business sentiment has in fact improved. And with it, so has business spending, which appears to be on a solid upward trend throughout this year so far. Businesses also began to rebuild inventory in the first quarter after very sharp cuts in inventories last year. And in fact, some of the big swing in GDP growth from the sharply negative to the more sharply positive in the past year reflect the roller coaster movements in inventories from sharp cuts to now accumulation. But even if we exclude inventories, final sales in the United States have grown significantly in the past 4 quarters. Some firms, particularly small to medium-sized firms that are dependent on bank financing, still report having trouble getting credit. For example, about a quarter of the manufacturers in our regional economic survey have said they've had some difficulty getting long-term financing for capital spending. A fifth of those surveyed reported trouble getting financing for short-term uses, such as meeting payroll and acquiring inventory. One expects that firms would experience, one expects that during recessions, firms would have trouble getting financing because they're typically tighter credit terms during recessions than other times. Yet as the recovery gains momentum, credit conditions will ease further for firms of all sizes, and that will continue to support business spending. Consumer spending, which takes up about 70% of GDP, has been stronger in recent months. Real consumer spending grew at almost 3.75% annual rate in the first quarter. Some of this rise reflects the improvements in household balance sheets as consumers have paid down debt. Some of this rise reflects the improvement in some of this increase in wealth comes from the rise in rebound in equity prices over the past year and the stabilization of house prices. The better consumption numbers also likely reflect some pent-up demand after the weakness we saw during the recession. Indeed, fourth quarter to fourth quarter decline in real consumer spending that occurred in 2008 was only the third such annual decline since World War II, an indication of just how deep this recession really was. Even so, I expect the growth in household spending will not be as strong as many previous recoveries because it's going to take some time for labor markets to come back and incomes to begin to grow more robustly. We also need to be careful and watch commercial real estate markets, which continue to lag the rest of the economy, as is typical in recoveries. Weaknesses in this sector could pose problems to small and regional banks that hold commercial real estate loans in such large proportion of their portfolios. While regulators have urged lenders to make prudent decisions and to continue lending to creditworthy borrowers, strains on banks resulting from these exposures could adversely affect credit flows to local businesses and consumers. I expect these risks will lessen and the commercial real estate market values will stabilize as the economy recovers, but it will likely take some time before we see much growth in this sector. Let me tell you now for a few minutes about the 3rd District, and more specifically about Delaware. Our district did not experience as severe a downturn in real estate construction and house prices as some other parts of the nation. The year-over-year declines in house prices in Wilmington and Dover metro areas, for example, have been only slightly worse than that in the nation as a whole. Nevertheless, the impact of the economic and financial crisis have been severe across our region. Some areas that had previously been relatively immune to national economic recessions have this time experienced much sharper declines in business activity and rapid increases in unemployment. And that's certainly been the case here in Delaware. Delaware's unemployment rate, which had run near 4% or lower for nearly a decade prior to this recession, shot up to over 8% last year and continued to rise this year, reaching 9.2% in March. Like the nation, however, our district and Delaware have finally begun to see some job growth. Indeed, Delaware's payroll showed a nice increase in March. We don't have the April data yet. After recent struggles, there have been other positive developments in the state. Plans to resurrect an oil refinery are underway, and the production of a hybrid electric vehicle plant are being considered. If asked to characterize the view among my regional business contacts, I would say they are cautiously optimistic. And my hope and expectations is that that sentiment will continue to improve as the recovery gains momentum during the rest of this year. Let me conclude by saying that the economy is now emerging from the Great Recession, the worst financial crisis that most of us have ever experienced. I believe that a sustainable economic recovery is now underway in the nation and in our region. As with all forecasts, there are risks. But as we move forward, I expect economic growth in the national economy of around 3.5% this year and next, with stronger business spending on equipment and software, moderate growth in consumer spending, and a gradual improvement in residential investment. As aggregate demand strengthens and firms become convinced that their economy is sustainable, hiring will pick up further for this year and next. The unemployment rate will decline gradually, but it will take some time before it gets to previously acceptable levels. As the economic recovery takes hold, we will need to begin to withdraw monetary stimulus to ensure that inflation stays low, inflation expectations remain stable and well anchored, and that our long-run goals of price stability and sustainable economic growth are in fact met. Federal Reserve policymakers take these goals very seriously. We are carefully considering all aspects of our strategy for exiting this period of extraordinary policy accommodations, and we will do so as we monitor the evolution of the economy and its outlook. Thank you.